I have 4 methods of earning passive income with cryptocurrency in this video. I'm going to go over the pros and cons of each of the 4 methods, how much you can expect to earn using them, and then how easy or difficult they are to pull off. Some of the methods use DeFi and some of the methods use CeFi. You can choose which method best suits you. I'll leave the timestamps in the description for each method so you can flick between them. And I'm going to go through how much you can earn in percentage terms, and then you can look at your own portfolio and really work out how much you have to invest and then how much percent on top of that you can earn. The first method though is providing liquidity. This is on DeFi. So you're going to have to go and use some decentralized applications like lending protocols or DEXs. In fact, this is fairly simple once you know how, and I have tutorials for each and every type of platform and blockchain, which I will leave in the description for you. But you can earn around 2 to 9% doing this. Now, this does change per application and per blockchain as well. It's not just a simple case of setting it and forgetting it. Unfortunately, yield farmers do have to kind of look at all the rates that are going on and change their assets around according to which platform is paying out. There are many different liquidity incentive programs that you're going to have to search out, but 2 to 9% is something you can get. What I've got right here is PancakeSwap, and I'll show you the actual site right here as well. But essentially, PancakeSwap is a decentralized exchange. So what happens is that, as you can see here, people swap tokens on the DEX. So people may swap Binance coin for BUSD. And you can see that down here, essentially when you trade, you pay a trading fee, right? So every decentralized exchange and centralized exchange will charge trading fees. Well, on a DEX, because you can provide your liquidity and your tokens, you get those trading fees. And so that is the passive income that you can earn. Now, I have many other videos describing how to provide liquidity on PancakeSwap specifically, and some of the things that you should worry about and keep in mind when providing liquidity, because it's not as easy as just putting it up there and earning the yield. It depends on what tokens that you're using, whether they're risk assets or whether they're stable coins. But you can very easily go on PancakeSwap and it tells you the reward you're going to get for adding liquidity. So for example, if you provide BNB coin and BUSD as liquidity, you can earn around 7.5%. So this is a really good yield. Now you're going to have to ask yourself a question. Do you want to provide these assets, or do you even want to invest in BNB? If you're invested in BNB, you might want to provide it as liquidity to get 7.5%. Now you can see other asset pairs earn a lot more and a lot less. There are reasons for that, which I can't go over in this video. Something called impermanent loss. It has to do with the volatility of the assets and the risk that they change price from when you put them in to when you take them out. I have other videos on that specifically. I'll link them all in the description for you. But as you can see, you can earn anywhere from 2% to much more than that. So this is a good yield if you're a long-term investor and you want exposure to these assets anyway. PancakeSwap is on the Binance Smart Chain, which is very cheap. PancakeSwap's a very popular app, but there are others, for example, Curve Finance, which is on Ethereum. Now, Ethereum's expensive, but Curve Finance, if you go up to the network, it supports a lot of layer 2 networks as well and cheaper networks, for example, Arbitrage, which I'm on here. It has most of the security of Ethereum, but it's much, much lower cost. And you can see some of the pools here. Now, Curve Finance focuses on asset pairs that are very similar to each other. And so it minimizes the bad thing, which is called impermanent loss. We don't want impermanent loss. So Curve pairs really try to minimize this. You can see right now you can essentially get 2 different versions of Bitcoin on here, paying you around 2.5%, which is a decent yield for DeFi for Bitcoin. Or you can choose a stablecoin pair, which is paying around 3% right now. Actually, you get more than that by getting the incentive tokens, which I'll show you right here. So what a lot of people do is they farm the incentive tokens from the DEXs and put that back into the token pair that they're adding onto the DEXs. I'll show you exactly what I mean by that. Something like Beefy Finance is going to do this automatically for you. There are others. I'm not kind of saying Beefy Finance is good or bad, but it's one of the most popular used. It's a multi-chain yield optimizer. Essentially what Beefy does is it looks at all the different DEXs and all the token pairs and all the incentive tokens that are paid out. What it will do, for example, if you put stable coins into a pair, it will take the yield from that, and it will also farm all of the incentive tokens that you get from the DEXs, and it will take the incentive tokens, sell them back into the pair that you're using to increase the amount of the pair that you have, and so you get yield on more, and then more incentive tokens, and it just recursively farms, essentially recursively yield farms and optimizes the yield for you. So if you can see on Arbitrum, I'm going to go to stablecoins here. That pair that I've showed you, which is right here, the stablecoin pair USDC, USDT, it says that it pays around 3%. But if we go over to Beefy, the recursive yield farming they're doing actually pays you around a 6.6% yield. So a lot of people use these recursive yield farms to essentially yield farm the incentive token, put it back into the strategy. So 6% on a stablecoin pair is very good. If you have other types of assets, risk assets that you want to farm, you can see them here, and it will show you exactly, what the best yield is for them. Stablecoin pairs are much less risky versus pairs that have risk assets in. So a lot of people use Curve Finance because a lot of the pairs are similar in nature. So then when providing liquidity on DEXs, it's really up to the token pair that you use, but you can earn anywhere from 2 to 9, even way more. I would use it for stable coins only. So I would put stables in there. And you can earn, let's say 5, 6, 7% on stable coins. Risk assets are very different. I suggest watching the video in the description. I'll leave my crypto course linked as well, because in the DeFi section right here, I have a couple of videos on divergence/impermanent loss, how to calculate it, how to think about using different assets. It's really important that you know that before adding liquidity, because a high yield doesn't necessarily mean you're making a return. So really important to know what impermanent loss is and why it's important. And I'll leave that linked in the description if you want to know more. The next way we can earn passive income on our crypto is by staking them. Now, obviously, this doesn't relate to stablecoins because stablecoins aren't staking cryptocurrencies. So you can't go into the safety of stablecoins and stake them. You have to use them as liquidity like we saw in the first section. But if you have a proof of stake crypto, staking it is obviously going to give you a higher yield right here. Now, staking through the bear market obviously means you're getting more tokens, you're compounding your tokens at lower prices, which is obviously preferable if you think the future looks bright for that crypto. Now, there are many ways to stake each crypto. I'll leave all of the videos in the description that specifically go through how to stake each one. I'm going to go through the percentages you can get those. So something like Lido is a staking provider. It's decentralized, so you can very easily link up your wallet right here. They provide staking for Ethereum, Polygon, Polkadot, Solana, and Kusama. Obviously, it's up to you which cryptos that you want to hold and think have a future. About 4% on Ethereum right now. Solana paying about 4.9%. But in general, depending on the blockchain and the crypto asset, you can make around 5 to 25% or even more with some strategies. So I'll show you this right here. This is just normal staking that you can do through Lido, or if you have a Solana wallet, you can use the Solana wallet directly and get these staking rewards. But there are ways to increase the rewards that you get. So right here is just an example of that. So for right now, Matic is actually offering some kind of bonuses for something called Staked Matic. This is very complex in how it works, but essentially you can now buy a Matic token that is giving you staking rewards, and you don't have to lock it up on the blockchain. But essentially, because this is new, you're getting a lot of rewards for staking on different platforms. So for right now, if you stake Matic, short term, you can get up to 92% APY or 147% APY if you put it into a liquidity pool with USDC. I personally would go for this one because there's no impermanent loss. So you're getting a nice bonus right here. And this is essentially yield farming, as we know it. Exactly how you yield farm staking cryptos is essentially by taking the normal version of the crypto and the staking version of it, and then putting them into a liquidity pool on a DEX like we saw in the first example. This works by essentially getting staking yields plus fees that people pay to swap those coins. But there's no impermanent loss because they are essentially a very similar asset. And so they have a very similar price. You can get around 19% through Beefy on this pair right now. And as you can see, if you use some other exchanges like MeshSwap, you can get much higher. I would always use caution with the new platforms and go to platforms that I know have been around for a while and are trusted, but you can certainly earn a lot by essentially yield farming what's called staking derivatives. I have a whole video on that, which I'll link in the description. It is complex, but 5 to 25% is doable with staking cryptos. So yeah, those methods seem really complex if you're a newbie, but you can get some good yields. The easiest way though for beginners is just to use lending apps. I use these and have used these in the past, use these now. Celsius and Nexo, probably the two main ones. They offer really good yields, around 2 to 10% depending on the crypto. They also have swap features in the app. They give free withdrawals for your crypto as well. Obviously they're centralized. Some people don't mind this, some people do mind this. You can obviously make your decisions. But you can see for stablecoins, Celsius pay around anywhere from 7 to 9%. And then on Nexo, they pay anywhere from around 6 to 10%. It depends on how many of the platform's tokens that you have. You can earn in Nexo tokens, which ups the rate a little bit. I wouldn't do that. I would just earn in the token that you're depositing, but up to 6% on Bitcoin and ETH as well. They give really good rates. They're very simple. They have swap features in the app. It's a centralized exchange that gives you, all of the features that you would want from, an exchange and a kind of passive income app. If you're in the States, a lot of these apps aren't available because you have to be a professional investor in order to actually invest in them. But, other countries may have access. I'll leave links to these below. Celsius actually give you a deposit bonus, $25 if you deposit $100, and then Celsius is $50 if you deposit, I think, $400. So, they give you bonuses, they give you good rates. For beginners, these are really what a lot of people choose. But, you can see if their rates are competitive as opposed to what you can get in DeFi. The next method to try and earn some yield out of the market is what's called a spot futures arbitrage. This is something that professionals do. Retail investors can't do this. It's too complex, but there are some trading bots that actually do this. I'm going to use Pinex as an example here. I use Pinex to do this as well. So you can earn around 7 to 12% depending on market conditions. Now, under the surface, essentially what they do is they go long in the spot market and short in the futures market. Now, if that doesn't make sense, I've got a video on this specific strategy. I'll link that in the description and how I use it. But essentially what you can see here is for Bitcoin and Ethereum, it tries to print a yield out of the market. So you don't actually have any exposure to those assets. What you're trying to do is just get the arbitrage out of the market. So you actually have a neutral exposure to the market itself. So you're not going to make or lose money from Bitcoin or Ethereum going up or down, but what you're trying to do is print a yield. So what you can see here is that, you can earn around 9% for BTC and 10.5% for Ethereum. Now, the yield can change, and it does change depending on market conditions. So there are some things to keep in mind with using it. I'll show you right here on Pinex. On the right-hand side, they have this bot right here. So for right now, the annual yield, if you hold for a long enough time, is around 10%. So that's a 10% yield on what you invest. So you can actually invest US dollar Tether, stable coins, and you have a neutral exposure to the market, like I said. So you're not making or losing money on Ethereum going up or down in price, but over a year's time, you may earn around 10% on your money. This yield may change depending on what people are doing in the futures market. And so it's a little bit complex, but you can see that they've shown you right here that it's around a 10.5% yield. You can also go to Bitcoin here, which is paying around a 9% yield. So you're not making or losing money on price movements, but you're just printing a yield through the arbitrage that this bot does. It's complex. If you want to learn more, I'll leave that video in the description. Now, you may have more questions than answers from this video because a lot of the topics are very complex, except for lending apps, which are really simple. You just put your crypto on there and earn the yield. But as a recap, you have around 5 to 7% on stablecoins if you just want to provide liquidity on DEXs. The second way is that you can just stake your crypto very easily. You can earn around 7% for that. Or if you want to do that strategy of using liquid staking derivatives and essentially providing liquidity on DEXs, you can up that to, let's say, 20%. Now, lending apps, by far the easiest right here, no doubt about it. Earn 7 to 10%, just put your crypto on those platforms. I'll link the deposit bonuses in the description for you. And then arbitrage bots. This is actually quite simple because you just use a bot and you can get 10%. As I just showed you here. So depending on the complexity of what you want to do and the yields that you want to get, these are roughly the yields that you should be getting across DeFi and CeFi. Like I said, I'll leave all of these specific guides and tutorials linked in the description if you want to see how these strategies work. And I'll leave the crypto course links up there if you want to really understand how I go about putting a portfolio together and earning passive income through the bear markets as well. I'm James with MoneyTG. Cheers for watching, and I'll see you in the next one.